Hello, I'm Will Thompson, and welcome to our Equities Buy Hold Sale. Today, I'm joined by Will Liu, Sam Koch, Anna Milne, Shaun Weick, and Cooper Rogers. We work together across the micros, small, large, and global portfolios. Will, Starbucks, buy, hold, sell.
Starbucks is a hold for us. Starbucks is a great business. They have this amazing opportunity in China where the growing middle class population there and increasing consumption of coffee per capita. However, at the moment, they're facing issues with their margin profile. There's encountering rising wage inflation, unionisation of the workforce, and we think that provides a lack of clarity. At the same time, China's adopted this zero COVID tolerance policy, and that's meant the opening up of the economy has been slower than expected, so the visibility isn't great. So Starbucks is a hold for us.
Treasury Wines, buy, hold, sell.
Treasury is a buy. So firstly, it's got a really strong asset backing. It's got the wine itself and then it's got the vineyards. And so that provides a bit of a backstop to the share price in these kind of volatile environments. And then additionally, I don't want to speak too soon, but with the new Australia government, it does feel like the China-Australia relations might be having a bit of a cautious reset. And obviously 2 years ago, Chinese put bans on Australian wine and they have done an incredible job of putting all that wine into different channels, but if it came back on, it would absolutely be a positive. So it's a buy for us.
Will, what about Twitter? Elon's been involved. Buy, hold, sell.
Yes, Twitter's an interesting one. It's all over the press. Elon desperately wants to get rid of this deal. Our view is Twitter is a sell. I think legal cases are very complex. It's a bit of a black box in terms of what happens. I think as investors, we don't really know what's going to happen, so it's best to be on the sidelines and there's better opportunities elsewhere.
Sam, the lack of cars in the market seems to be everywhere over the papers. What about SG Fleet?
Yep, SG Fleet for us is a buy. SG Fleet provide fleet leasing services whose volumes have been heavily impacted by COVID and the lack of new car supply. Following their acquisition of LeasePlan, we see the opportunity for revenue and cost synergies to outperform market expectations. And coupled with recovering in new car supply, we see meaningful earnings growth over the next few years. We see value in the name at 10 times price to earnings ratio and a 7% div yield.
Shaun, you got a good looking tan, back from the US recently. Webjet, buy, hold, sell.
Yeah, the beaches of Santa Monica were nice, mate. Much better than the Sydney rain. Webjet's a buy for us. I guess, yeah, as you mentioned, it provides really strong leverage to the recovery in domestic and international tourism. If you look at consensus analyst estimates on this name, you're essentially implying a recovery to pre-COVID levels in the second half of 2023. We think that's too conservative. We think the Webjet business is a significant structural beneficiary coming out of the pandemic, given the competitive set has been rationalised. And if we look going forward from here, we think the market's underappreciating the technology investments that they've made and the upside that provides. So it's a buy for us.
Maas Group, buy, hold, sell.
Maas Group's a buy for us. We've recently been out to visit their assets, which are located throughout the central west of New South Wales and Queensland. It's a vertically integrated business materials and construction company. Management owns 60% of the stock, so there's very strong alignment there with shareholders. The area of the business that we think the market's underappreciating is the property strategy. If you look at where that's currently held at around $200 million on the balance sheet, and over time we think there's capacity for that to be realised at 3 to 4 times the value. And the other angle around the property is on essentially recycling of capital, where there could be a spin out into a REIT structure over time. All this for a stock trading on a sub 12 times PE. You know, we continue to see acquisitions as a strong catalyst for it. We like that one as a strong medium story.
And Cooper Resources, MinRes, buy, hold, sell.
Yeah, Min's a buy for us. We think just with their own projects alone, they're expanding their lithium and their iron ore projects, along with the majors expanding as well. Their mining services division is underwritten for a 10% kind of growth on their EBITDA line next year. Along with that, we really do like their lithium business. We think it's undervalued versus its peers. We think MD Chris Ellison's going to come out at the full-year result and outline a really strong strategy for that division. We think that's a catalyst for this stock to re-rate. It's a buy for us.
And on the lithiums, they've had a great year. What about Liontown?
Yeah, as I mentioned before, we really like keeping an eye on all the lithium names. They've had a decent pullback in the last 2 months, so some of them are looking good value around here. Liontown, we really like the project. It's a tier 1 ore body that they've found. First production, though, is expected in Q2 2024, so it doesn't quite fit our investment process at this time. because we think it's going to move with the commodity price more than near-term catalysts. This is a hold for us, for now though.
How many computer screens do you need at home? What about JB Hi-Fi? Buy, hold, sell.
JB Hi-Fi is a sell. Like all consumer discretionary names, it's absolutely been hit over the last few months. And we just can't really get confidence around the earnings profile over the coming years. As you said, everyone's bought so much over the last couple of years, and we just don't know how high that's going to be in the household priorities in terms of spending to come.
And Sam, everyone's getting outdoors. There's a wild flu season. What about Probiotec? Buy, hold, sell.
Yeah, Probiotec for us is a buy. PBP essentially manufactures and packages products for large pharmaceutical companies in Australia. This is a founder-led business that, whilst they will benefit in the short term from the record flu season, we're more attracted to the high win rates, which are driving a market share opportunity in Australia. The business is undergeared as well. The balance sheet's undergeared. We see ample opportunity for them to supplement organic growth through M&A. It's trading on a 12 times price to earnings ratio with 16% EPS growth forecast, and the catalysts are M&A and earnings upgrades.
And as everyone's outside, what about oOh!media? Buy, hold, sell.
Yeah, oOh!media for us is a buy. oOh!media, unfortunately, has been impacted heavily through COVID, through the foot traffic. They own static and digital billboards throughout Australia. Effectively, we believe that as foot traffic returns in city centres and airports, like Shaun spoke to, we'll see a recovery in sort of ad spend away from TV, away from online digital, towards their static and digital billboards. Really, it's trading at a 30% discount to its historical average in terms of price to earnings ratio. It's probably the one COVID recovery pay that you're not already paying for.
And Cooper, SRG Global, buy, hold, sell.
SRG is a buy for us. It's benefiting from the positive tailwinds of maintenance, mining and infrastructure in Australia. It's also turned around its earnings into a higher quality earnings structure in the last couple of years. Longer term annuity style contracts that they've delivered on makes it more attractive for investors. It's a buy from us.
And Shaun, Propel Funerals, buy, hold, sell.
Yeah, so Propel Funerals is the second largest funeral home operator in Australia with about 5% market share. This is one with fundamentals that you don't want to like, but they really do offer a pretty attractive recovery profile as, I guess people exit lockdowns. We've seen flu rates are skyrocketing at the moment. So we think the organic growth profile of this business is re-accelerating. And then if we look at, I guess the significant cost escalation we're seeing through inflation out there, we think these guys have an ability to pass that through. The balance sheet's very strong. They've got over 300 million in capacity they can deploy into earnings accretive acquisitions. Listed peer InvoCare's at about 20% market share. They've essentially tapped out with the ACCC, so we can see a pathway for Propel to essentially quadruple its footprint over time. So this is a strong buy from us.
And Will, every dad's favourite product, WD-40, buy, hold, sell.
Yeah, I love the WD-40 product, but WD-40 is a sell for us. If you look at their cost of goods sold, 35% comes from crude petroleum-derived products, and that's clearly going up. Logistic costs are also going up. So CEO's recently stepped down. It trades at over 30 times PE with a mid-single-digit organic growth rate. So we think that's a bit too expensive. WD-40 is a sell.
And into luxury, what about LVMH?
LVMH, Louis Vuitton, Moet, Hennessy. So clearly, the luxury space is a great space. Secular growth tailwinds. LVMH own a great portfolio of brands with unreplicable heritage and history. So Louis Vuitton, Christian Dior, Bulgaria are key brands that drive the earnings profile. For the moment, given it is consumer discretionary, given there is clearly cost of goods, cost of living pressures right now, we think on the margin, consumers are probably less willing to spend $5,000 on a leather handbag. So we're on the sidelines. Definitely a stock we could own in the future, but for now it's a hold.
But if you won the lottery, maybe you could afford a handbag. Anna, what about the Lottery Corporation?
Yeah, so the Lottery Corp is extremely defensive. In good times, people have the money to buy lottery tickets, and in bad times, people want to win the lotto. So the Lottery Corp was recently spun out of Tabcorp, and it's got fantastic defensive qualities. It runs monopolistic long-term licenses across most states of Australia, and there's not really too much we can criticise them on, except we think it's fairly priced, and so it's a hold for us.
And then also, feeling the pain at the petrol pump, maybe some lottery can help there. What about Santos?
Yeah, so Santos, if you're wanting a hedge to petrol pump pain, I'd say buy Santos. It's a producer, so it benefits from higher oil prices, and it's kind of been caught up with the hype of the Woodside BHP Petroleum merger. It's been left behind a little bit. Its current share price implies that oil is trading at $60 a barrel, when reality is it's north of 100, and we think it's going to be elevated over the medium term, so we like Santos, it's a buy.
And Cooper, Champion Iron, buy, hold, sell.
Champion is a buy. It's a Canadian asset. It's a very high-grade iron ore mine. A lot of the power comes from hydro, and so it's seen as a bit of a green angle on iron ore. The very high-grade iron ore can either be sold as is or pelletised, and that's used in electric arc furnaces, which create steel at a lesser emission rate than the traditional blast furnaces. So it's a green iron ore play. We really like it. It's also doubling its production at its Bloom Lake facility, so you get that growth as well. It's a buy for us.
And changing sectors, Sam, Botox, what about Silk Laser?
Yeah, Botox. So Silk Laser is a buy for us. So Silk Laser effectively provides non-surgical aesthetic procedures and services to its clients through a network of 120 clinics in Australia. If you think about what that actually is laser hair removal, Botox and skincare products. Now, the market's really worried about a recession and the impact that a recession will have on a type of business like this. We believe that their products are a lot more defensive than what the market's implying. Earnings growth of the short to medium term will be driven by new clinic rollout, the full year contribution from the acquisition of ASC, including synergies, and really a recovery from the lockdown impacted period in the first quarter of FY22. So trading on 5.5 times EV/EBITDA this year versus unlisted transactions that have done effectively double that, 10 or 11 times, we see value here.
And Will, what about Arthur J. Gallagher, buy, hold, sell?
Yeah, Arthur J. Gallagher is a strong buy for us. So Arthur J. Gallagher is a US-based mid-market insurance brokerage firm. So the really attractive thing about this business is that it's incredibly resilient through economic cycles. So in 08, 09, it actually grew its revenues. Our investment thesis was validated recently. They had their investor day. They reiterated their 9% organic revenue growth target for this year, and they're going to expand margins by 10 to 20 basis points, and that's pretty attractive in this current environment. So it's a strong buy for us.
Shaun, Lovisa, buy, hold, sell.
Yeah, Lovisa's a buy for us. In general, we are cautious on the retail sector, given the concerns around a recession, but we think fast fashion jewellery is largely recession-proof. If we look at the go-forward growth strategy from here, it's really around store rollout. We can see capacity for this business to more than triple its current footprint. They've opened up 5 new markets recently, and if we look at management's LTIs, they suggest that there's significant upside to consensus earnings expectations. So as a result of that, we think this one's a diamond in the rough and it's a buy for us.
Anna, ASX, buy, hold, sell.
So there are a few puts and takes with ASX at the moment. There's obviously a lot of volatility in the market, which they benefit from, but at the same time, there are a lot of listings and capital raises that have been put on ice, which is a negative. So it is a sell for us, predominantly on valuation terms. Can't critique that it's a high quality name, but we just can't get there on valuation.
Will, SAP, buy, hold, sell.
Yeah, SAP is a buy for us. SAP is an enterprise software provider based in Germany. They're towards the end of their multi-year transition away from license revenue to cloud revenue. So what that means is as the share of cloud revenue goes up, there's better predictability, but higher rates of recurring revenue, and we're starting to see a profile where operating margins can expand meaningfully. So we think it's a really attractive business, mission critical to its customers it serves, so it's a buy for us.
Cooper, Emerald Resources, buy, hold, sell.
Emerald, it's one we acquired through the takeover of the Euros portfolios. Hasn't performed so well since then, but we still have it as a buy. It's creating cash, it's paying down debt. This is all from its main asset, Okvao, which is in Cambodia. It's a low-cost gold producer. It also recently took control of the Bullseye asset, which is in Western Australia. We think there's exploration upside there that's massive, and we're looking forward to them drilling that out. It's also had a share price movement that's been probably adverse to where we think it should be over the last couple of weeks. We think it's a good buying opportunity, so we're stepping in here and buying. It's a buy for us.
Sam, record grain prices, Graincorp, buy, hold, sell.
Graincorp's a sell for us. It's a company that doesn't need much of an introduction. However, it stores, processes and transports grain around Australia. For us, it's a sell because it's actually benefited from a number of one-off events that we don't think we don't see happening in the near future again. Australia's had a couple of bumper crops. There's been port transportation issues, and there's also been obviously the war in Russia and Ukraine, which have really artificially inflated earnings in the short term. So we really see conditions normalising, margins deteriorating, and unfortunately the share price derating as a result.
Shaun, Top Gun and Elvis, cinemas were packed when I was there. What about event hospitality?
Yeah, no, completely agree. Events are buy for us. I mean, this stock does provide, strong leverage to the reopening themes. They own a collection of cinema assets in Event, the hotel assets in QT and Ridges, and also Thredbo. If anyone's seen some images of Thredbo recently, the lines are big and the pizzas are expensive. But yeah, I guess for us, this is really around, a valuation play. We think if you back out, the implied value of the operating businesses at the moment, you're paying roughly 2 to 3 times EBITDA for businesses that we think can earn significantly more coming out of COVID. They've got $2 billion of property assets on the balance sheet. Current market cap's $2.3 billion. Yeah, we think this one's a good play in this market.
Anna, CSL, buy, hold, sell.
CSL's a buy. So it's a complex business, but if you think about each of the divisions, firstly, there's the bearing business, which is the generally plasma-derived products. That's been under-earning for a number of years now, and we think it's really just starting to hit its straps. Seqirus is the vaccine business, and I think everyone knows it's been a pretty horrendous flu season down under, and we think that will probably translate to the same in the Northern Hemisphere, so they're set up for another really good year. And then there's the V4 transaction, which has been delayed, but management is still very confident that it's going to close, and we're really excited about the pipeline of drugs there. So CSL's a buy.
Well, that's all we have time for today. Thanks for joining us.